Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we take a considered look at a different theme from the world of investing and attempt to apply the lessons laid down by the man widely regarded as a father of the craft, tutor and mentor to none other than Warren Buffett. We're of course talking about the great Benjamin Graham. In this edition, we're going to look at a subject that doesn't always receive the attention it deserves: the inevitability of getting things wrong. For while value investing provides us with the tools and the intellectual framework to achieve long-term success, it makes no promise of perfection. It cannot and does not claim to shield us entirely from error. We'll explore why mistakes are an unavoidable part of the process, what we can do to protect ourselves from them, and why, despite its imperfections, the disciplined practice of value investing still offers the best odds of getting most decisions right most of the time. So without further ado, let's dive right on in. As ever, sit back, strap in, and prepare to absorb another lesson in intelligent investment as inspired by Benjamin Graham. It is almost too obvious to state, yet too often ignored. As investors, from time to time, we will get things wrong. We'll make errors, and the inevitable consequence is that occasionally we will lose money. Not every swing of the golf club will result in a hole-in-one, and not every over produce a boundary. Every so often we'll back a dud, and there's no shame in that. It is simply part of the game. Now, if you happen to be any good at all at this value investing business, many of your errors will be of omission rather than commission. The missed opportunities. Those moments when you fail to buy a company that subsequently quadruples in value. It's painful, especially when all the indicators seem to be flashing by, but for one reason or another, you didn't pull the trigger. Still, missed opportunities, while frustrating, rarely destroy wealth. Today, we're more concerned with the other type. The investments you did make. The horses that you backed that subsequently pulled up lame. Broadly speaking, these errors fall into two categories. The first are the unforgivable mistakes, the ones that stem from inattention, a misplaced decimal point in your spreadsheet, a calculation entered incorrectly, or a failure to spot the ticking time bomb buried in the notes of an annual report. These are the painful lessons, but if you're diligent, they should be few and far between, perhaps once or twice in a career. The second category is more forgivable, and arguably more instructive. Those mistakes where, despite doing everything correctly at the time, subsequent events conspire to invalidate your reasoning. You carried out the analysis, you assessed the intrinsic value conservatively, and you purchased with a margin of safety. Yet the world changed in ways you could not possibly have foreseen. My last major misstep falls firmly into that latter camp. Back in 2019, I identified what appeared to be a significant value opportunity in a UK business called Workspace Group. For those unfamiliar, Workspace provides flexible office space, similar in concept to WeWork, though with one crucial difference. Workspace owns the majority of the properties from which it operates. That ownership structure, I believed, gave it a stronger foundation. Its success was tied not only to the profitability of its operations, but also to the underlying value of its property portfolio. In contrast, many of its competitors were heavily exposed to lease obligations and thin margins. Workspace, by comparison, seemed to possess tangible, defensible assets. And at the time, the shares looked cheap. Even with a healthy margin of safety built in, the company could be bought for substantially less than its estimated net asset value. I made the purchase. What no one could have foreseen, of course, was the world-altering event that arrived in early 2020, the COVID-19 pandemic. Now, it's true that every business was affected by lockdowns, but for companies like Workspace, the impact was structural, not cyclical. Remote working, once a rare privilege, became the norm. And once the habit was formed, it proved remarkably sticky. 5 years on, many firms continue to embrace hybrid models, and a full return to the office remains elusive. As a result, the demand for traditional office space has declined, dragging down property valuations across the sector. Workspace's share price today sits more than 50% below its 2019 level. Crucially, this doesn't feel like a temporary setback. The underlying fundamentals of the business model have been permanently altered. That's not to say the company won't adapt or that its shares won't eventually recover, but any such recovery cannot be relied upon or forecast with any degree of confidence. With hindsight, it was an error, yet I don't lose sleep over it. The decision was made on sound reasoning, based on information available at the time. I applied Graham's principles conservatively, rationally, and with care. What changed were the facts themselves. And even the very best in the business are not immune. Warren Buffett himself has been candid about his misjudgments over the years. Perhaps his most famous blunder was the purchase of Berkshire Hathaway, the textile company that would later lend its name to his investment empire. In 1965, Buffett gained control of Berkshire because it looked cheap. On paper, it was a classic value play, trading below book value, with tangible assets and seemingly recoverable earnings power. Yet the future, as ever, had other plans. The American textile industry was about to face a tidal wave of foreign competition, as lower-cost manufacturers from abroad flooded the market. Domestic production in the United States soon became unviable. Buffett, in his own words, had bought a terrible business at a cheap price. Some have since estimated that his initial investment in the textile operation cost him as much as $200 billion in foregone compounded returns, money that could have been far more profitably deployed elsewhere. His forays into the airline industry, both in the 1980s and again decades later, have been well publicised disappointments. Likewise, his investment in Tesco, the UK supermarket giant, proved a costly one when accounting irregularities and operational challenges eroded confidence and value alike. Yet, in most of these cases, the original reasoning wasn't unsound. The problem lay in subsequent developments, changes in the competitive landscape, consumer behaviour or regulation that were unknowable at the time of purchase. Even Buffett, armed with perhaps the sharpest analytical mind in the business, cannot predict the future, nor could Graham before him. Value investment, for all its discipline, offers no protection against the caprices of fortune. It's easy with hindsight to proclaim that Buffett should have foreseen the demise of American textile manufacturing, or the cyclical ruin of the airline industry, or the relentless price wars of the UK grocery sector. But such pronouncements are mere hindsight masquerading as foresight. So what hope does the rest of us have? The uncomfortable truth is that none of us, not even the most rigorous practitioners, can avoid mistakes entirely. Even businesses selected through intelligent analysis, purchased with a margin of safety, and held with patience, will, on occasion, disappoint. The real question then is not whether we will make mistakes, but how to protect ourselves when we do. Benjamin Graham provided two principal lines of defence: the margin of safety and diversification. The margin of safety acts as a cushion between the price you pay and the intrinsic value you estimate. It cannot fully insulate you from disaster, but it can greatly reduce the severity of any blow. If you buy $1 worth of value for 60 cents, you have a buffer, a margin within which unforeseeable errors or adverse developments can occur without entirely wiping you out. Diversification provides the second shield. However confident you may be in your analysis, spreading your bets across a sensible range of holdings ensures that no single failure can cripple your portfolio. The occasional poor decision, while bruising, will not destroy your results. In the arithmetic of investing, survival and consistency matter far more than brilliance. As Graham himself put it, the essence of investment management is the management of risks, not the management of returns. Mistakes, in truth, are the tuition fees we pay for experience. They are painful, yes, but they are also instructive. Each one, examined dispassionately, teaches us something about the process, about discipline, patience, or the limits of our foresight. The worst response to an error is denial. The best is analysis. We cannot undo a poor investment, but we can extract from it lessons that will serve us for decades to come. As investors, humility is our greatest ally. The market has a way of humbling even the most confident among us, and that is as it should be. The discipline of value investing is not about being right all the time. It is also about being prepared for when we are wrong. Graham's philosophy endures precisely because it acknowledges human fallibility. It replaces prediction with prudence, speculation with calculation, and ego with process. And so, the next time a position turns sour, resist the temptation to beat yourself up, or worse, to abandon the framework that has stood the test of time. Instead, remind yourself that even the most intelligent investment process cannot guarantee success. It can only tilt the odds in your favour. Over an investment lifetime, that tilt can make all the difference. And that's all for this edition of Intelligent Investment today. If you found it worthwhile, do consider subscribing or adding us to your playlist. And if you can, continue to spread the word. It really does make a huge difference. I'm David Coombs. This has been Intelligent Investment today. Until next time, stay safe and happy investing.